Well, Shawn Hickman, research lead at Market Matters, joins me here. Shawn, hi.
Hi, how are you?
Good to see you. So let's bring up the chart from last night, because we always like a good chart to illustrate what we're talking about. It's hard to complain about this, but what's the actual price action telling us?
I think it's telling us the point I issued last week, or said last week. Not too bad is good enough. So we're going into the Fed decision this week. We're going into some big results, Meta platforms, or the old Facebook, Alphabet, or Google, as most people think about it. They're reporting. The market's had a decent bounce. If they're not too bad, if we don't see anything too scary from those results, I think Market Matters believes the market, and the tech sector in particular, can pop higher. Okay.
So when we think about what's actually been going on under the hood, so is this, investors really favoring one sector, one stock, or one thematic over one other?
I think the market's bearish, the market's negative. So we saw that from the Bloomberg weekly update this week. I think 70% of those people surveyed think or believe the S&P 500 will break last year's lows. That's a pretty dramatic bearish stance. Our view is generally markets don't go down that far when most people are bearish. So we believe this year is all about, as it was really last year, sector and stock rotation. And there are plenty of opportunities within the course of the year. But as we can see from that chart there, really the S&P hasn't moved in about a year plus, 18 months.
Okay, what happens to the US dollar? We have seen the US dollar rolling over a bit, but if we do have any sense of fear coming back into the market, presumably it would act as a safe haven currency again?
I think so, and I think at some stage this year we're almost guaranteed to get a degree of fear. There will be, in our opinion, a period of time this year in the cycle where the markets get nervous again, whether it's about a recession or whether about the Fed or the RBA getting too aggressive again. Time will tell when they come into play, but that will probably send the US dollar higher. I mean, it's had a heck of a correction, as we can see, maybe 12%, give or take, off those highs. Our view is that the US dollar is ready and looking for a base to have a bounce back to 105, 107 on the dollar index perspective. That will create a headwind, if we're correct. We're likely to create a headwind for the likes of the gold sector, the resources, etc.
Well, that's what I was going to ask, because you can talk about the pressure being put on commodity prices and appetite with the US dollar, but then you've got as well, China demand coming back in.
Absolutely, it's like a fascinating jigsaw puzzle at the moment.
Yeah.
Once you've got all the pieces, it's too late. So you've got to decide how you're going to play that jigsaw puzzle without all the pieces being there. Our view is that in the bigger picture, by the end of the year into next year, we want to be overweight long resources. At the moment, we're market weight. So we're not letting go of the resources position. We were very overweight maybe 3 months ago. Our view is we've taken a bit off the table because we think that US dollar will bounce. But as it does, if we're correct, we'll be going back into the sector in a more aggressive manner.
What about, and we can bring the next chart up, what about resources versus growth companies? Because there should be presumably a time that you would want to bring growth back into the portfolio, and that includes tech.
Okay, well, we are overweight tech. We have been probably since September, October last year. We went a little bit early, but they've done pretty well this year. I mean, Seek is one stock I've talked about on this show for quite a while. This year, most people might be surprised to know that Seek's up about 16%. I think it is the same as, say, South 32. These are two stocks. I'm not sure if you've got the chart there for them. Okay, so they've both had a really good move this year. Our view is that in, say, 6 months' time, 3 months' time, timing is a guesstimate. We'd rather be more overweight South 32 than Seek. So if we can see a 10% swing in the relative performance of those two, we can see Seek getting up to, say, $25. Obviously, it's not going to do that today. If we get that move in the US dollar, we can see South 32 coming back under 450. They're not big moves, but that would be enough to have us tweaking the portfolio around the edges, which was what we believe this year is about doing. Just tweak around the edges. Don't get the one wood out. The market's probably just going to give you some nice opportunities to move between stocks, move between sectors without being too aggressive in either way.
I mentioned the flooding in Auckland and some of the very minor in comparison flooding that we saw in Sydney yesterday. You've brought a chart for the insurance index here in Australia. Are you anticipating that it will continue to build momentum in this interest rate environment, or how are you reading this?
I think we put that in our morning report today. Our general view is that the insurers have been moving very closely, especially with stocks like Suncorp, very closely to the banks.
Yep.
We prefer the banks But when you see CBA touching $110 again yesterday, basically its all-time high, going into its dividend next month, we just feel like risk-reward point of view, we're not aggressively going to sell our banks, but we wouldn't be chasing them here. And that's the same feel for the insurers. They've run pretty hard. As a sector, they're close to their post-COVID highs, and we just wouldn't be chasing into them.
So that's IAG. I had a chat with somebody yesterday who said that they would prefer Suncorp over IAG, and yes, splitting out the bank and everything else. But what did the charts tell you?
I think exactly the same.
Okay.
I mean, IAG hasn't moved for years. It's gone sideways. It's had emotional roller coasters within that time frame, but it hasn't moved. It's yesterday we saw it came out and let us know that 25% of its provisioning for catastrophes is being used up in the New Zealand floods, which means it's quite conservatively placed. Really, hopefully there won't be 3 more disasters this financial year. But it's just not, in our opinion, gotten the good enough reasons, risk reward, excitement to go into it. We just don't see any reason to buy it.
Okay. So look, insurers have never been exciting, but I do want to push the point on CBA. If you've got CBA at all-time highs,
yes,
why wouldn't you be selling some?
Okay, well, to start with, you've got a big, fat, fully
Well,
franked
dividend is on the way.
Yeah,
yes,
exactly.
Yeah.
We're market weight CBA. We're not overweight
Okay.
CBA. Our 3 banks holding in our flagship growth portfolio are CBA, NAB, and Macquarie Bank. So slightly different mix there. I've been in the market for way too long, which probably can show by the wrinkles on my face. And I've seen people regularly, and brokers regularly say, it's time to switch CBA to Westpac, time to switch CBA to ANZ. I'm yet to see a long period of time where that's actually proved correct. So I don't see any reason at this point in time to be jumping out of CBA. If I was aggressively overweight CBA, we'd be thinking about trimming it back to market weight up here around 110. But I wouldn't be surprised to see 115, 120 if the market holds together okay.
Okay. All right. Well, that's one. So, Kate, you said that the insurers are not that exciting. You're sort of not going all in with the banks. What's an exciting stock right now?
Okay, I'd probably rather be. We've moved towards 12% cash after being fully invested into January. So I'd rather be flexible right here, right now. Opportunities will arise, in our opinion, over the coming months. Today, is there a stock I'm looking to buy right here, right now? The answer is no. Not that I think the market's in trouble or about to come crashing down, unlike a lot of other investors. I just think some flexibility around the edges is the way to be. So I'm actually going to give you quite a boring answer and say right here, right now, we're probably not going to be buying anything too aggressively. But if we're right, the opportunities will come. For example, South 32, if that goes below that 450, we'll start buying.
Okay. Great wrap up of what your thinking is on the market right now. Any sort of macro factoring into your views? I mean, we've got such a big macro risk event, FOMC, ECB, BOE, lots of data, US jobs. Next week's the RBA. Or are you looking through all of that because the expectations are pretty well baked in?
You've certainly given me a headache with that list. There is a lot going on.
Me too.
There is a lot going on. And I think we have to look forward. What is the market factoring in? The market's factoring in the Fed. I mean, most people now believe that it's the results coming out of the likes of Apple or the likes of Alphabet, Meta platforms are more important than actually what the Fed does, because they think that they know what the Fed's going to do. They think it's pretty much under lock and key. We know we're going to get a couple of rate rises, probably pop over 5%. That's fine. That's baked in the cake. So our view is for the opportunities on the cyclical, on the macro point of view, just watch that US dollar. I think the US dollar is the key to this year to opportunities. If it has a push back up, start buying back into the resources. But that's what we're looking at. We're looking at the US dollar moving forward. I think it's going to give the most opportunities. All the other factors are huge. They're really, really important. But you can spend hours and hours and hours trying to second guess whether the RBA will go 0.25 or maybe 0.5. But it's not having that big an impact on the market at the moment. So just don't get too wrapped up in those little details, even though I should say big details.